Last Saturday, I met with a GEPF member whom I had helped almost 10 years ago. And what was remarkable to see is how much had changed for this member during that time. Now, we initially started off on the GEPF retire resign decision, but things evolved and none of us would have ever predicted where she got to and where she is at this point in time right now. And the reason I'm sharing this with you is that when you are focusing on your GEPF retire resign decision, it's important to factor that life changes. Things are not going to stay the same. And when they do change, you need to ensure that your financial planning is flexible enough to accommodate for those changes. Now, in this video, I'm going to be covering retire, resign, but from a very different view. We're going to be talking about flexibility, which I believe is quite an important factor for you, and you're going to see exactly why. In fact, I'll share with you 3 essential tips that are going to help to show you how you can significantly enhance or increase the flexibility and actually gain more control over your wealth. Now, by the way, my name, if you're watching this for the first time, my name is Devon Naika, and I want to welcome you to this video series. I'm a certified financial planner, and I've chosen to specialize in this specific area, which is GEPF retire resign planning. Now, let's get started with this video. I have a lot that I want to share with you. I'm heading over onto the iPad so that you can get some clarity. And I have made some notes for you because I want to make sure I'm covering all of the elements that I feel is important for you. Now, remember also, we're talking about something that is change. And I've given you an idea here of what's changed for this particular member, but things can change for yourself, right? We'll have to obviously view this from your perspective, and you want to have a look at how other elements could be adjusted for you. So let's go take a look. The first element that you need some degree of flexibility is in terms of the cash lump sum that you have available. Now, keeping in mind, when making this decision on whether to retire or resign, you know, on your aspect of retiring, you have a choice of the gratuity benefit. And on the aspect of resigning, you have the choice of what I've referred to in my videos as the true 1/3 value. Now, where does the flexibility come in here? Remember, all the while, we're going to be viewing things from the perspective of tax. And if we head over onto a tax guide, you can see that tax in our country is structured in a very simple way. The more you earn, the more you're going to pay. Now, as always, remember when you are completing tax, you want to ensure that you're looking at the latest tax guide. I'm looking at the latest one at the time of this video being recorded. And when it comes to the lump sum that you have access to, your lump sum gratuity, it's taxed according to this table if you are older than 55. Right? If you're above 55, it's taxed according to this table. And you can see here, currently, the first 550,000, there's 0 tax. And then it works on a sliding scale. So the more money that you are taking out, the more you are going to pay in tax. Now, where does the flexibility lie? If you have the ability of pre-98 tax, which is an extra tax-free benefit that members who started before 1998 have, then you know you've got some extra amount that's tax-free. But even if you don't, you want to be able to have your lump sum to be flexible enough. So you want to be able to adjust your lump sum tax, meaning if you're going to be taking over 1,155,000, you can see SARS is going to take away 36%. So to give you an example, let's head back onto the iPad. For every amount that exceeds that 1,155,000 that we've just seen, let's say you go 100,000 Rand more, then SARS is going to take 36,000 away from you. This is what it means, right? And the money that you'll be left with is 64,000. So once you go over that threshold, for each 100,000, remember SARS is taking 36,000, which is a significant amount of money, right? If you take R1 million, then they're taking away 360,000. It's quite a significant amount. So if you have a degree of flexibility, that means you can adjust your value. And if you've managed your finances well, then you can take a little less. And that flexibility is important because by adjusting your value, taking less, you are then paying less tax. And because you are paying less in tax, it means you're having more money that's in your pocket. Now, in this case, from a flexibility perspective, keep in mind that there's no real adjustment that happens on the retirement side. Because the gratuity benefit is predetermined, you have to take that amount, which means we don't have the flexibility there. On the resignation side, now this is key. there are options that allow you to adjust and to create flexibility. But again, you need to ensure that you're getting the right advice for this. There are many cases where members have not got the right advice, and as a result of it, the resignation was poor, right? They ended up paying more tax than what they could have paid. Now, you'll see inside of this YouTube channel a number of testimonials of members that I've helped where it highlights the importance of flexibility as well as the importance of significant tax saving. So your first tip here is you need flexibility in terms of the cash lump sum. The next one is flexibility in terms of monthly income, because guess what? At the time of you retiring or resigning, STARS is not going to forget about you. They're still going to remember you, and they're still going to want to have a piece of the pie. And what piece of the pie is it? Well, that piece of the pie is in terms of your income. So heading back onto the tax guide again, you can see here that tax is calculated, and I'm viewing this for individuals, and will still apply to you when you retire or resign. I often get cases from members saying, hey, I've retired now, my tax is going to be reduced. It's not the case, right? Remember, retirees pay the same tax as ordinary individuals. There is a change that would happen, but it's based on age, and I'll share with you now. So again, your tax is calculated on a sliding scale. More you earn, more tax you're going to pay. You can see here, starts off at 18%, and then it jumps to 26, 31, 36%. It keeps going higher and higher. Where the change comes in is when you get to 65 years. So again, doesn't matter whether you're retiring or resigning. The moment you get to 65 years, you can earn more income and pay less tax. This is what it means, right? In addition, if you are above 75, then again, you can earn more income and pay less tax. So let's have a look at it as per this tax here. If you are below 65 and you are earning 95,750, then you won't pay tax, right? That's the threshold. You only pay tax when you earn above that. And then if you are between 65 and 75, can you see you can actually earn more money? So you only start getting paid or start paying tax when you're earning above 148,000 here. And if you are above 75, you only start paying tax when you are earning above 165,000. Now, why is flexibility important here? Because when you're making that decision of retiring and resigning, if you can adjust your income, you can then pull your salary to a lower tax bracket, right? And this again is very, very possible. Again, if you have a look at the testimonials, you'll see this is how I'm planning for members. You want to adjust the tax. It doesn't mean that you're going to have to force yourself to live a lower quality lifestyle. It just means you can apply your planning in such a way that it's becoming more tax efficient. So heading back again on your retire, resign decision, I'm heading back onto the iPad. Keep in mind when choosing to retire or resign, here on retiring, you are going to receive an income, but it's predetermined, right? It's the figure that GEPF is giving to you. It doesn't allow you much flexibility. You can't really adjust that. On the retirement side, there are 5 different ways to earn an income for life. I share that in another video. And again, depending on the option that you choose, it is possible for you to adjust your income. And why that creates an advantage is you could take a lower income initially, it reduces your tax, and you can always change this at a later stage, right? Meaning you can adjust your income every year. Again, I discussed that in detail on those 5 options. So you want to have that kind of flexibility of income because things can change in the future. Maybe in the beginning, you might not need so much of income because you have access to your cash lump sum, but you might need a higher income at a later stage. So this degree of flexibility is quite important for you. The next factor, and this is something that we wouldn't have anticipated, right? And I'm sure you won't anticipate, or I know for sure this was something that the member that I'd helped didn't anticipate, right? Losing a life partner. We all know that at some point we're going to close our eyes. We just don't know when. And it tends to happen at the time that you least expect it. Now, I want to share with you some tips here, or some factors that I want you to keep in mind, right? Is the tax on income. So if you are married, let's say in community or property, let's say a COP marriage, the income that you are earning is being shared between the two of you, and it's taxed accordingly, right? Which means you taxed according to your income, your partner's taxed according to your partner's income. However, if your partner closes their eyes and you start receiving an income from your partner, now you are earning 2 incomes. And this is where things start to change, right? Keep in mind the tax table that I shared with you earlier. So you might be receiving an income here. And this could be an income whether you retire or resign, right? But you are receiving your income. Let's call it as your income. And then you would receive an income here, let's say from your partner, right? I'll call it late partner income, which is coming to you, right? Now, this is what had happened for this member. So let's say, again, the same situation, you're now receiving an income from your late partner, which means you're earning two incomes. Now, why this is important is from a tax perspective, SARS is actually going to add both sets of income together. And what we've seen just now on the tax table, the more you earn, the more tax you're going to pay. So this is naturally going to bump up your tax. It's going to increase your tax because now you're earning a higher income, which means, again, you need a degree of flexibility, especially if you don't need such a high income on both sides, right? If you are able to adjust your income here, you could take a little less because you don't need it, which then reduces your tax. Now, again, it doesn't apply if you are retiring. It could apply if you are resigning, depending again on the option that you're choosing. So something for you to factor. Then you also want to factor tax on interest. And the reason I'm sharing this one is if you are married in COP, community of property, or again, depending on your marital regime, right? Your interest that you're earning, which is money that you kept in the bank, let's say, or a unit trust, that interest is shared between you and your partner. Now, that's a big advantage because then it helps to keep your taxes low. But if you lose your life partner, now you don't have that leverage anymore. It means all of that interest is now accruing to you, which again could bump up because this is how SARS would view it. They'd look at interest here as a third element. So when they are adding everything, it's all added up together, which again can push you up on the tax bracket. So you want to be mindful in terms of that. Then you want to factor tax on there. So again, losing a life partner, or if you're a single individual, touch wood, at the time that you close your eyes, you need to factor what would happen to your capital that's left behind, keeping in mind that on your retirement side, it is a bit restricting, right? Depending again on your kids' situations, if you close your eyes within 5 years of retiring, then there's some money that could be passed on to them. If the kids are disabled, there's a benefit that could be passed on. But usually, right, in most cases, we've seen this from members where the kids are not really benefiting from this, especially when a member comes to retirement age. On the resignation side, it is possible for you to have the money to filter over, but then you want to start looking at some tax planning because you have to factor ways in which you could keep more money going over to your kids or your grandkids leaving this legacy and less money heading over to SARS, which again can be done provided the initial structure of your planning is correct. An increase in the living expenses, well, this one's pretty self-explanatory, right? We can't control it. If you have a look at water, it's going to be constantly increasing, electricity constantly increasing, fuels increasing. So you want to factor that because if your income is fixed and expenses are increasing at a higher rate than your income, then you're eating away disposable, right? It's going to make it very difficult for you to live financially. Whereas if your income could be adjusted, if it's flexible enough to cater for that, then you can change it to accommodate. Same with things like grandkids, because once you get your grandkids, or maybe you've already got your grandkids, you know the bond that you're creating with them, and it leads to you spending a bit more, isn't it? Buying more things just because you want to spend more time. In essence, do things that you weren't able to do for your kids because now you have that ability. But you want you want your income to be flexible enough to cater for that. And then kids moving home. And this had happened to this member that I had assisted, where the kids have moved to another province. And then it resulted in the member actually moving, right? Selling home and moving across. Again, as I say, it's things that we don't take into account when you do the initial planning of retiring and resigning. So comment below, let me know, what are some of the elements that you feel could be changing in your lifestyle? And what really stands out for you here? What are some of the things that you feel is important for you? Do you want to have your income to be flexible or fixed? Comment below and let me know. Now, I have put something else important here, and I made a note of the importance of your relationship with, and I didn't complete it, right? I'm going to complete it now. It's your relationship with your financial planner. And this is how I feel when it comes to financial planning, especially on the GEPF retiring, resigning side, right? And more especially if you are heading the route of resignation, because it gives you the ability to customize something, to create something that is personal and specific for you. you want to ensure that it's always kept at pace, right, with your changes in life circumstances. And I see this clearly for this member. Each time that we had engaged and I got to see some change in a circumstance, I was able to adjust or tweak her plan so that it's optimized for tax, so that we're optimizing it for growth, so that we're optimizing it for legacy, leaving over to her kids. And this again made me realize the importance of the role of financial planner, because this is not just something that you want in the beginning. You want something ongoing so that you have peace of mind in the beginning, yes, but as your life circumstances start to change, you still keep on with the peace of mind because your plan is being molded and adjusted accordingly. Now, again, I hope you found the video very helpful. If you have, give me a thumbs up so I know that it's good. And if you're watching this for the first time, please go on and click the subscribe button, because then you get to see these videos as soon as we put them up. I shall see you in the next video.